So we're a little bit ahead of schedule. We've still got 4 minutes until the start. So why don't we wait for the others? And in the meantime, just send through anything that you need to go through. In particular, we're going to look at the Jackson Hole tomorrow and just go over what happened today, really, with regards to the data and the setups that we were looking at and the strength in this US dollar ahead of the Jackson Hole. US 30 we'll look at for sure. We'll look at the euro. Okay, no problem. You're welcome. There's something termed fear of missing out and FOMO. So, you can do all your analysis. You can have the perfect setup lining up. You've got your rules written down. You've got them in your head. But the market plays mind games with you and starts pulling you in before the trigger. Happened to me today. I went in early on, what was it? On the S&P 500. But I noticed what I'd done wrong, and I took a loss. I came out early before my stop. I just took it out. I could have waited for it to go to break even. It was very close to it, but for the sake of a couple of $100, it's just not worth it when you're winning trades. See that times mucho. So if you make a mistake, just get out of the trade. um, that's what I have to say about that. But yes, patience, timing is very important when you're trading the open. These this 3 hour window around the open where volatility is rife and mistakes can happen if you're trying to spin too many plates, or the price just moves very quickly. Um, Swing trading is an easier approach, perhaps. Um, that's where I started. I started swing trading. Your stop losses are miles away from your entry. Um, your target points are a lot further away as well, and you've got plenty of time to get your head around what it is that you should be doing, and you've got time as well to notice the mistakes if you make any, and you've got that window to fix them. So I think we've got enough here. We're how many seconds away are we? Give it 30 seconds. Okay, yeah. Well, I would start by trying to remove any gut feeling. When it comes to trading, gut feeling is going to lead to disaster. um, I mean, I hear of people that talk about, oh, just my intuition. I do well with my intuition. Yeah, until you blow your account. All right. So your approach to trading, if we're day trading the markets, you need a strategy, you need an approach. It needs to be mechanical. It needs to be something that you can rinse and repeat day in, day out, or week in, week out. Maybe it's not going to turn up every day. Your setup, your strategy, your rules for engagement may not turn up every day. You might not find those setups every day. And again, that FOMO kicks in. Oh, well, I've got to trade. I've got to do something. I want to click the mouse. I want to hit bid. I want to hit the offer. I want to hear those pings when my alarm goes off and when my order goes through. And MT4 making all these noises. And no, it's not about that. It's just not a game. So gut feelings don't come into it. Right, let's get going. So we will start off by looking at what happened today in terms of the data and markets. So markets in general were focused on the events to come, all right, with Jackson Hole, in particular looking at Jerome Powell and ECB's Lagarde, but most attention is going to be, well, reportedly will be on Powell. The reason I say that is because that seems to be the wild card. Um, the market has been, well, we'll get into that in a minute. Right, let's stick with the data as I said we would. So today, it was all about the dollar and yields and how the data would affect that. We had on the back of yesterday's PMIs that were a disappointment worldwide, but including the US, that sent the dollar lower. And we talked about the correction, which we got, but then we continued higher and took out the highs. So that bearish bias thesis technically has been invalidated, right, with that move up because it's broken yesterday's high. So we've got a higher low, a higher high. Where was that? Let me see where we got it from. I don't know if that high was higher than that one, but it was thereabouts, an equal high. Let me just take off this. No, so yeah, it was a higher high yesterday. So we've got that staggered build up of flow, and then we came down to break it, get it making a change in character, only to correct, and we've gone on to make a higher high. So that break of character, that break of structure has been invalidated with a new break of structure, as per this indicator shows you. So it's a useful tool to have in your charts if you haven't already. So let's look at the data. As I said in the Discord, on the back of the data coming out, virtually as soon as it did, I said that is dollar positive. And we had a mix of jobless claims that eased. Actually came out with them easing by 10,000 to 230,000. But overall, these levels are relatively steady. So that was a dollar positive on the data itself. But in general, this trend is expected to continue in the coming months. So let's see how that pans out. With the Chicago Fed's National Activity Index, where there's been a fair bit of focus on that of late, it also rose to 0.12 versus minus 0.33. Now, that's important because what the markets are looking at is whether the Fed rate hikes are going to lead to a recession. That's the concern. And in fact, bad news is probably good news for the US dollar in the event of a recession. If you look over history, the dollar tends to increase in value because of the role that it plays within the wider global economies, right? So there's a saying: if the US sneezes, the world catches a cold, and the US dollar is required for international business and so forth. And there's a lot of debt which is denominated in the US dollar around the world. So if you haven't already, I think I've mentioned it before, look up the dollar milkshake theory. In fact, I might even look it up for myself now and stick it in the chat for you all. Just bear with a minute. So let's go to this one here. I like this one. So that would be a nice watch. It's, what is it? A 6 minute video only, or less, or more? 6 minute video. But it sums it up very well. But if you want to look into it at more depth, then you've got Brent Johnson here that is interviewed through various media streams. Brent Johnson. Um, so he's the inventor of the theory, and it's well worth watching. Anyway, so back to the data. So this Chicago Fed's National Activity Index rose, um, and I was saying that's important because to signal a recession, the 3 month average of that index would have to drop below minus zero point 0.7. So by this measure, the U.S. economy is far from a recession. All right, and I think I mentioned uh, that there will be focus on that data in the morning meeting. Um, and then also we got, now some were uh, asking, well, but the durable goods was a miss, right? The data fell 5.2% in July, but the core measure, which is I put more focus on, actually increased by 0.5% month on month. So that also indicated that the US economy remains resilient. So, with all of that feeding through, eventually that dominated and drove the dollar higher, and we saw a lift in yields, continuation in the yields. So, unfortunately, our thesis for the impulse correction and continuation to the downside was wiped out by the data. Had we not had that data come out, then the normal flow of market would likely have um, resulted in what we were looking for. But nonetheless, there were trading opportunities all over the place, um, in line with the thesis and against the thesis. So um, I personally, what did I trade? I made a mistake in the S&P, but I recovered that tenfold in the Nas. Um, so with the S&P, I just got in too early over here, and I realized my mistake, and I got out. Took a very small loss, a fraction of my risk, and instead of getting back into the S&P, I was distracted. I can't remember why I didn't, but I chose the Nas, and that paid off well. So again, we got the pump up, the consolidation, and the dump. This is the bread and butter trade. Um, we see this time and time again: pump, consolidation, dump. That's all it is. Very, very simple. Trading at its best is very simple. So these setups are what we're looking for. All right. We had the same setup in gold, but it didn't come off. All right. That's not to say it's going to come off every time. Um, so I reversed it and went the other way. So we had the pump up, the consolidation. We had the makings for the dump. Right. I got in early. I believe I can't quite remember what I was doing, shorting that. If there was a setup or not, trigger. I can't remember what I was doing in here. Anyway, there was a sell. That's perfectly good to sell that. Um, I can't remember what the trigger was, so excuse me on that. But going the other way, I'll have to have a think about that. I can't remember. Busy morning. So, but going the other way, um, it was a break of, so flipping the, yeah, that was it. It was on the dollar in yield. So I got my cue from the dollar in yields. What do you buy when you want to short the S&P? So what is negatively correlated to the S&P or positively? Well, so if you feel that the S&P is going to drop, then you would be buying into, well, you'd be risk on, risk off. Sorry, you'd be risk off. So in that respect, you would likely buy gold, right? So that paid off. You would buy the yen. Momentarily, that paid off over here. But then we had a turnaround in the US dollar. So stocks, right? So the indices are regarded as a risky investment. So you would want to, um, they're a risky investment. So risk on, a risk on environment, you're buying stocks. A risk off environment, you're selling stocks. And then the correlations would be, so you have gold regarded as a safe haven, the yen regarded as a safe haven. You would sell, so if the stocks were coming off, you would sell Aussie yen, New Zealand yen. Um, Probably New Zealand yen is more favourable because of the interest rates higher in New Zealand than Australia. Um, and bonds risk off. So when bonds are going up, yields should be coming down. All right, and we saw some of that earlier on in the day, but then they returned higher. Okay, so bonds have an inverse relationship with yields. So the more demand there is for bonds, the less of a yield they're going to pay out. All right, but we can look at yields as a guide to get a feel for what environment we're in. Are we in a risk off or risk on environment? So when we came in, yields. So when we came in on the day, yields were rising. Yields were rising. So that could signify, in fact, with bond prices coming down to attract investment, that we're risk on. But generally speaking, with the US dollar, the dollar is going to do the opposite to the stocks. So if the stocks are dropping, then the dollar should be rising. And then yields are supporting the dollar because of the differential between, say, the Bank of Japan, to some degree, the ECB, for the expectations that the Fed are longer, staying higher for longer. Okay. So in terms of let's turn to the Jackson Hole, or is there anything? No, let's go to the currencies then. So you want me to look at? I was being asked to look at the Dow and the Euro, US 30, the Euro. Okay, well let's look at the. Um, well, okay. I'm being asked here. What is the difference between yields and bonds? Right. Well, a bond will pay out an interest rate. It's a coupon rate. Okay, and it's expressed in the percentage of its par value, the face value of the pound of the bond, in other words. And then when you've got a you've got the bond yield rate. So there's a lot of noise going past my window. 1 minute, I've got to turn off the microphone. Give me a sec. Back. Sorry about that, guys. So we were talking about yields and bonds. So there's an inverse relationship. Essentially, what you've got is you've got um, the bond's yield is the rate of return that a bond will generate. Sorry, still lots of noise. Bear with me, please. And all sorts going past my convoy of cars and celebrations of some sort. Anyway, so a bond's coupon rate is essentially the rate of interest that the bonds pay annually, and then the yield is the rate of return the bond generates. Okay, so when you look at the value of bonds, when they go down in value, the yields rise. Right? When there's more demand for the bond, okay, the yields will will be lower because the bond is going to pay less. Right? So the coupon rate will rise to attract investment. But when there's already investment, then they drop. These are traded on the money markets. Okay? I don't know if that helps. But essentially, when there's risk, investors turn to bonds as a safe haven. They're regarded as the safest asset that you can own because the governments guarantee the debt. So whether or not that stands true, I don't know if they're legally allowed to default, but I think they can. But anyway, that's yields and bonds. All right. So any other questions? Let me know on that. Right. The US 30. The US 30. Now this is interesting, and I think I did do a video on this for someone earlier in the day. But what I was talking about was this could be Wyckoff type of accumulation. And what we're seeing here might be the spring. So anyone interested in that, look up Wyckoff accumulation distribution. You have these schematics, and the schematic is essentially, let me pull this up to a regular chart. The schematic, the direct definition I can't be sure of, but essentially is the um, the structure of this accumulation, right? So this is a schematic, and this schematic has various stages, and this stage here might be the spring, right? And the spring is essentially a stop hunt. There's liquidity below these lows, so this might be the stop hunt, and then the move up, and then the continuation to the upside. All right, so similarly, we could say the same for here. You've got the stop hunt and then the continuation to the downside, this distribution. So we've got the same thing here. Maybe a spring is in the making, just like over here, and you get the market returning back into the consolidation before the move up. So this was a sign of strength. Buyers are engaging. This is the spring, more accumulation to occur before the move up. All right. Alternatively, we can have a continuation, pullback, and an ongoing move to the downside. So that's on the daily chart. If we move this down to a 4-hour chart, a continuation into perhaps this support area. Okay, we could. Well, I can't remember if this made a what kind of correction this made on this daily impulse. Let's have a look. Came in close, or did it reach the 38.2? Can't see. Yes, it did. So it tapped into the 38.2. That for me is a trigger to start looking for the downside, and we just got it in a flash on the same candle. It's not very helpful, but the correction, measuring the correction, we've come into the minus 272 already, and where I've drawn that uh, potential demand area, we've got the minus 61.8 of that corrections range. So I've measured that corrections range from top to bottom on that Fibonacci scale, and these are my targets for the downside. Considering we've already done the 272, then there are prospects for continuation to the minus 61.8, and that aligns with the structure that I drew a second ago. So that's the downside potential, and then we've already spoken about perhaps this is just a fake out, a spring, whatever you want to call it, before the real move comes and up she goes. Okay, so that's the US 30 covered, and now we're going to look at the euro. Euro was a first green day today, so the consensus that I had at the start of the day was for a continuation to the upside, and we didn't get that. So we talked about how the market tested the downside, failed to break or stay low, came up, closed higher than the closing price. So that indicated to me that bulls are coming into the market, and we were just waiting patiently for our buy low opportunity. But instead, where was New York? Instead, we got that, but the data and the change in sentiment around the Fed, which we'll come to in a moment, flipped, and we saw that dollar strengthen. Despite the dovish comments from Harker. Okay. So what's the outlook now? Well, let me try and draw up another thesis live. Give me a second while my brain ticks over. What we'll do is we'll start from a top-down analysis, put things into context of where we're actually at. So we are breaking structure here to the downside. All right, so we came up, lower, up, higher, high, higher, low. That has been penetrated in this move. We're going to close below that level, so that now turns to resistance. Doesn't necessarily mean the price will stay below it, but there's a high possibility that when it comes up to retest it, it will fail to convincingly break through it, and sellers will be emerging around here to keep the price on the back foot lower, in line with the bearish trend. Okay, so we are bearish on the daily chart. On the 4-hour chart, we're less bearish. We had a break of this structure, but not, well, we didn't have a close, so just note that, but one would argue that we are coming down into the origin of the displacement of this strong candle, coming down to fill orders in here, and the price after doing so will revert to the upside, potentially fill in this wick, this candle's wick, move up and retest resistance. So we're more neutral on the 4-hour time frame for the time being, in anticipation of a potential correction of this drop and prospects, in fact, of a continuation higher. All right, so we need to watch that, how that plays out. So critically, in order to invalidate such a thesis, we need to break the recent lows and stay low. Okay, so breaking those will not be enough. We need to really penetrate those, break out below the lows, and stay low. So breakout, correction, low, continuation. Okay, and then on the 1-hour chart, we are front side so far of this bearish trend. We're coming into this order block area, which is precisely there. All right, so buyers could emerge from here, and if they do, they could take on the trend line and start building accumulation for the move up. And if we come into the 15-minute chart, where do we have structure? We're looking for the lowest high before the lowest low, which was arguably here, here, up to the lower low. In this leg, the lowest one is down here on that leg, right? So, but if we get a break above here, and then there as well, because this will be resistance in here. But technically, if we break that lower high, we are technically breaking the trend. But what I would argue is until we break, let me see now, I'm going to pull that out. We would be breaking this leg, not that leg, this leg, this leg here. So although it looks like we're on the back side of that, we're not quite, because we haven't broken that high. If and when we do, then this will be a counter trend supporting line. So the market will be on this side of it, and the next phase would be a break of here to classify this trend line as broken. Because presumably if it breaks that there, it's going to be breaking it over here. The breakout will be here, and then we're really building our bullish thesis for a continue up to the upside. Okay. Right. So let's get to the Jackson Hole then itself, and then we'll wrap things up. So essentially, what are we looking for? The market is starting to price in the prospects of a hawkish speech from Powell. He speaks around 10 a.m. New York, officially 10:05. So his speech will be closely scrutinized for signals of further interest rate direction. Now, the switch up here is a market that back in June were starting to price. The market was starting to price in rate cuts, but at this point, the market is now backpedaling and there is a skew towards higher interest rates for longer due to an extended period of strong growth in the US economy. How do I know the market is pricing in hawks? Well, you can just see it in the price action. Look how strong the dollar is in yields. Um, Let me look at the world interest rates gauge. Let me see if I can find something on that. No. I'll have to report back on that in the morning. But essentially, you can see it in the price. If Powell indicates higher rates for longer, but towards pause and not increase, how would the markets react to this? If Powell reacts higher rates for longer, that's all. That's all the market's going to react on. Because higher rates basically invalidates the notion of pausing. So interest rate hikes and a sustained period of high rates. You can have pauses within that, but that isn't an interest rate cut. So the market is going to be more uh, biased towards sentiment around higher for longer. You can have pauses within that cycle, but the fact that rates are higher for longer, the stock markets will not like that. Um, what else can we say about that? So yeah, so I think, well, from what I'm reading, that's the way this is being tilted. So expecting a hawkish outcome. Now, anything other than a hawkish outcome would be obviously bullish for the stock market, and that could be the fuel for our theory on the US 30. Perhaps this is just a stop hunt, and then the real move is going to come over Friday, Monday, and Tuesday of next week, setting us up for a stronger market. Yeah. So it's really a matter of waiting and seeing how this pans out, guys. You know, we can sit here and try and guess it, but that's not going to be helpful. Okay, no problem. You're welcome. So that's all I have really to say on this. It's really a matter of seeing how things go. Tomorrow, shortly, well, hold on. I'm in a meeting with Wayne. What time did he say? Oh, wow. He wants to get together bang on when Powell is talking. So maybe you guys will enjoy that. So let's do that. Let's have a Jackson Hole Powell um, meeting, and we will report on what he says live. Myself and Wayne and I. All right. So I'll send out that invitation in the Discord channel, and hopefully we'll have a good number of you there. It will be interactive. Um, no, it won't. Well, yes, but me and Wayne will actually be live with our webcams on, audio, and we'll have the chat. We can be answering your questions. Yeah, I don't know. Sassy way. Yeah, at 10 o'clock. All right. I'd urge. In fact, um, yeah, we'll go live 10 a.m. Pal is usually late. All right, so it's scheduled at 10:05, so 10 is fine. All right, so get there early, guys. 10 o'clock, ready to go. I doubt very much. Someone's asked if we will share our entries. I doubt very much I'm going to have any positions open during that. Um, we'll have to see how it sort of evolves. Okay, 12 p.m. in Australia. Okay, Zeb. In the morning meeting, we will talk about potential outcomes and would look at potential ways to navigate around it and trade the Wall Street Open and PAL, but I'm not sure that I'm going to have anything open over PAL. I mean, my stop loss would have to be miles away, so it really erodes the point of trading for me. I'd rather be in and out on the day and then close it all down and then start again the next day. Maybe Powell's speech and Lagarde. Lagarde will be of note. All of that might take some days to filter through in the markets for the dust to settle. All right. So we're going to wrap it up there, guys. Um, Sorry I couldn't be more comprehensive on the Jackson Hole, but it really is like, licking your finger and putting it in the air and trying to guess which way the wind blows. I mean, you don't know. Exactly. Okay. Okay, guys, have a great evening or day wherever you are. My football tournament starts tonight, five-a-side, so I'm looking forward to that. Hopefully, I won't break a foot or leg. All right, guys, see you later. Thank you very much. Yeah, we'll